Hello, everyone. Does it work? Yes. Ivan, I'm doing DeFi at Ethereum Foundation now. Previously was a co-founder of Gearbox protocol, which is still alive. Honestly, haven't moderated in a while, so I hope you're all not sober at this point, so that any hiccups you will totally ignore. Please meet the panelists today. Phil from Cork protocol, Ben from Superset, Lorenzo from USDT Zero, and Jackie from Bridge. You want to start with a round of intros about what you do?
Sure. Hi, I'm Phil Fogel. I'm building Cork protocol. We're building a new primitive for DeFi, which is risk tokens, so that you can take apart any risk in any different asset and price, trade, and then hedge your risk.
Hey, I'm Ben Haslam, CTO and co-founder of Superset Finance, and we're building this brand new multi-chain architecture for unifying liquidity of multi-chain assets into one single market to give the best execution.
I'm Lorenzo. I'm one of the three co-founders of USDT Zero. We are the largest on-chain movers of USDT between all of our 25 supported ecosystems.
Hi, I'm Jackie. I lead issues data at Bridge. Bridge is an infrastructure company for stablecoin where we do on-off ramping, we do issuance, as well as stable-backed cards.
Okay, so what should we start with? When you get to the topic of today is building the best stablecoin liquidity in fragmented markets. At least I can read still. When you get to that topic, there are a few things you could consider. One is FX, one is just liquidity and efficiency. Another one is questions related to centralization, decentralization when it comes to swaps, liquidity on chain, solvers, and whatnot. So we'll try to touch all of them at least partly. Let's start with maybe everybody loves to reminisce about the old DeFi days, right? Lorenzo was just crying behind the stage yesterday about it. So let's start off with that. Previously, when you would get a stablecoin on chain to bootstrap its liquidity and usage, you would go like the route of pretty much V-wars, right? You would have curve balancer, incentivize some votes, that gets the initial liquidity, then you get some oracles, then you get it listed on lending markets, and then if you are successful, you might get to centralized exchanges. Most of the stablecoins stop before that last step. But what do you guys think? Is the path still the same today, or is the ask for new stablecoins totally different when you want to get that initial liquidity at least? What do you think?
I think it depends on what you mean by stablecoin, right? If you have a yield-bearing stablecoin that's really something that's closer to a synthetic dollar and is actually a credit product wrapped in a stablecoin wrapper, it's very different. If you're trying to create a payment token that is Genius compliant, it really is about a lot of that same activity. But on the credit side, if you're talking about synthetic dollars, it's a very different game today because actually what you want is distribution. It's not necessarily so much about how do I have instant liquidity for lots of people in very small amounts, or it now is much more about how do I find big institutional type buyers for these tokens.
Yeah, I really agree with that because I feel like the market has really shifted from more liquidity first to more demand first. So like today when you issue a stablecoin, it's not really just like how do I mint this token? It's a lot more about the holistic stack of like, okay, after minting or like during the minting, I need to think about the reserves and I need to think about the on-chain, on-ramping, off-ramping, so it's connected with the real world. I need to think about the utility, like why do people hold my token? How do I get that distribution channel, like have a lot more? So yeah, I think today is like kind of on the surface, sure, you work with market makers, you get these DEX liquidity going, you get listed on centralized exchange, but today, I think the starting point, it's much more different.
I also just think there's more to consider than there wasn't before, such as which chains are you even going to launch on now? Like back in the day, it was like pretty simple, it would be Ethereum and maybe a couple of others, but now there's like a dozen different chains you might want to launch on all at the same time. And then what is the liquidity provision? What are the markets you're even going to create on all of those? Are you going to have markets on all of those?
Yeah, I guess so. I mean, on our side, we're pretty lucky, I have to say, because we can tap into both sides. We have the centralized liquidity of USDT, which is the best stablecoin liquidity in the world. And then what we do is just we take that, and then we allow for frictionless movement between all the supported chains, which basically allow us to basically pick up a few chains with very deep liquidity, and then all the others can just tap into that directly. I really wouldn't want to be in the shoes of someone trying to kickstart this whole process all from the get-go, because it's extremely hard and it takes a year to get it right, even if you just want to do it on the on-chain finance side and not on centralized.
Yeah, and I think what ends up happening is it really depends who your users are, right? If you're USTD0, right, you actually care about, I need instant liquidity to other stablecoins so people can go and take my stablecoin, convert it to another stablecoin to then go do what they want with it, and that has to always be on and always available. When you've created a yield product, what actually matters about who your user is how do they want to redeem this? What do they care about? Do they care about being able to exit this instantaneously? Or is there only a subset of users who want to care about this instantaneous redemption ability? And will they pay for that? And do you now have to, so you don't necessarily have to create liquidity the way you did before.
Nice segue. We are kind of feeding off the quotes of one another, right? First, the question was set up for Lorenzo to perfectly talk about that, and Phil piled up, so I can pile up on this one now. Speaking of conversion and the liquidity in fragmented markets, really, since a few years ago, we kind of moved away from the AMM model, right, where every liquidity was on DEXs and you would just have everything there. I remember like back in 2020 when was UST? Around 2020, right? Still there.
UST?
Yeah.
UST was big in 2020. 2021, so I guess, was big.
Back in the days, like we would even watch the 3-curve pool on Curve Finance, right? And if you see the discrepancy there, even for something like USDT, you would think, oh, something is wrong there. Even though comparatively, it was a really tiny percentage of the entire supply. Then we moved away to the solver model, right? So a lot of these things you don't even see on chain as much anymore. So would you say it became, of course, you could say it became more centralized, right? But do you think it's going to continue that way? Or do you think we're going to pull back a bit and just make on-chain liquidity a bit more efficient?
I think you need both, right? Like you have on one side the Causal of this world and all the solver infrastructures, but you also still need that bedrock level of liquidity that is there, that is regulated by AMMs and so on and so forth. And especially for lending and risk assessment on lending protocols, you always want something like that because you always need your atomic executions and et cetera, et cetera. So I think I'm very happy that we're moving into a world where solvers are more into play because there's way less need for capital sitting, not exactly idle, I guess, but not also in the same level of APYs that I would like to have my capital sitting on AMMs, and still gives pretty good experiences for users, especially the average trader or retailer, unless he's trying to go from a USDT into Aave, and in that case, it's a big of a problem, I guess.
I think it's interesting, in 2020, 2021, the best way to monitor risk between stablecoins was to look at a 3-curve pool, which was wonderful, but it's also totally absurd that is, and today in 2026, that is still probably the best way to monitor stablecoin health and the risk of stablecoins is to actually look at something like a 3-curve pool instead of there being an actual way to look at risk. And I think it's gotten a little bit better. You do have stablecoin ratings from places like S&P, and a couple other people are actually starting to do more on the rating side, but those ratings are static, right? They were done at a point in time. They don't actually monitor something on a real-time basis. If you look at TradFi markets, credit markets actually exist to really give you real-time pricing and information about the risks in different products. And that's what we need in crypto markets. We need a way to actually have credit spreads and products like that in order to actually see this actually in real time.
Yeah, and I guess just a comment, since I feel like these days when we talk in DeFi, it's like 3 months is 3 years. So it's very interesting that we're like looking back into like 2020, 2021 period. I think we've moved come a really long way. Like back then, there's only like a UniV2 where like Curve 3 pools, and this is old news. I know we all know this, but with Uniswap v3, right, the concentrated liquidity model, the capital on chain is much more efficient. And last year, we've seen a bunch of prop AMM popping up as well. So I think even in the on-chain world, sure. I just looked at this the other day. We have like on average, less than 1% of liquidity sitting on chain. I think we are approaching that world where it's like pretty efficient for the on-chain, especially the top tokens. But where I think about is like still, like nowadays, I do data. So at Uniswap, even back then when I was doing data, like I would still go look at the central exchange fee and look at the price ratio there. So like, is there a world where we can just like rely on the on-chain world for some of these like Oracle? Like, I'm not sure we're there yet.
I should also mention that it was extremely easy to try to depeg USDT via the Curve pool. It requires way less capital to do that via the 3 pool compared to actually attacking the peg of USDT via centralized exchanges. It's something that requires way more capital, way more money, because the market are objectively more efficient when it comes to centralized order books, I guess. I still remember the days where we were all waiting on Twitter on trying to understand why there was 90% of the 3 pool being USDT and the rest was being withdrawn.
Yeah. On that topic, actually, one ways I see now protocols are trying to do things is to look back and, okay, how can we use capital on-chain more efficiently? For example, if you look into AMMs, majority of the liquidity there, right, is spread out so much that at a certain point in time, only a small percentage of that gets used, right? For example, lending protocols started looking into things like, okay, what if you are having your debt, which is in the same time in an AMM, right? So that's one way to look at it. Yes, we reciprocate collateral in a way, and you kind of expose it to both risks, but maybe that's the way to do it, right? Another way, I think, without naming names, right? Other protocols who are not lending, but more so on the aggregator side, they're trying to make it as such that liquidity that's, for example, in your wallet at the time can be used for swaps and things like that. Do you think this is the right way to go? Or do you think it's too risky because you somewhat use the same asset for multiple purposes at the same time? Or, yeah, what are your thoughts?
It depends on the goal, and it depends on what you ultimately need. If you as a user are relying on for example, if you're a lending protocol that's relying on capital to absolutely be there, you need that capital to be there. You can't have it be that, oh, it was sitting in someone's wallet when I last looked and now it's not there anymore, but I built my underwriting strategy based on the fact that that capital was there at the time. So sometimes you need committed capital that you know is locked and going to be there for a long period of time. Other times it's perfectly fine to say it doesn't need to be there and we can be more capital efficient. But you need to be able to pay and price that efficiency.
Yeah, I agree. I think when it's basically in a protocol that's built with that in mind to be as efficient as possible, you can definitely do it right. Like, basically in Superset, what we do is we have this virtualization layer which allows one deposit of a pair on one chain to basically be used to do trades on multiple chains at once. So it gets a lot more fees, but then all the liquidity on a given chain can then be used for multiple different pools at once. And we basically have these abstraction layers so that does work in a fair way. And I don't think it can be exploited, or like you couldn't find yourself in a situation like the one that you described because it's all custom made for this one protocol. But then it does make it much more efficient.
I agree with both of you.
Since we kind of started talking our own shop at this point, which again, natural, right? If you're a builder and you're working on a team, you have your own certain sets of opinions, right, that you want to push forward. So let's just do one by one, because also interesting, I think, to learn about specifically what is your vision for the product that you are building and why you made some choices like that. For example, Lorenzo, let's start with you with USDT Zero. I think at some point when bridges and like the infra of bridging started popping off, a lot of it was just custodial bridges, then it was like solver-based Moderator and so on. And at some point, the asset issuers came out with their own direct redemption vehicles, right, that you can just deploy something. So for USDT, it has happened a couple of times that they would deploy their own like native way on the chain to redeem an issue directly. And then I heard some questions, okay, why do we need this like replica essentially? You heard this thing a lot, right? So what's
a lot for the last 15 months straight. So yeah, you're totally right. Like it all starts with this idea that you do need to have some kind of interoperability layer between chains, because in 2026 it's actually holding back a certain product or a certain stablecoin not having this feature, right? And it also makes a lot of sense on why it takes a lot of time for the largest stablecoin in the world to kind of innovate on that. It's because if you are the largest in the world, you also have a responsibility to go slow and make sure that everything that you do is battle tested and shows actually real demand. For the last 15 months or so, I don't remember the exact date, the native USDT deployments have basically been scaled down to 0, and all of the new ecosystems, Plasma, Tempo, et cetera, have all been consolidated underneath the USDT 0 standard. I think just because it's something that is gives a little bit better user experience for the end user that actually holds the stablecoin itself, right? It's been an uphill battle, I have to say, because for the first few months, it was extremely complex to try to explain people why the need was there. But like, 15 months later and $82 billion in volume between chains later, it actually becomes very clear that if you take what is already, in my opinion, the best stablecoin in the world, which is Tether itself, and you just try to make it, as I usually say, I sound like a broken record at this point, 1% better, you actually get to a point where you get a lot of usage and we can do it with, in a very frictionless manner. And we want to keep doing it, and 2026 for us will be, 2025 was basically the year of first initial expansion. We launched like 25 chains, we were very aggressive. 2026 for ours will be still partially consolidated on the expansion side of things, but it was also going to be trying to make the experience for all of those deployments that had the native USDT deployments back in the days a little bit better. We do have a product that serves that. It's called the Legacy Mesh, but it's something that we think we can do better, and I think in the next few months we'll be able to actually bring to market way better solutions for the actual end user. So we are pretty excited to get to that.
It looked like for a second Jackie disagreed with you there. Maybe we're just halfway through. to give you a chance to argue on that maybe perhaps, but I'll throw a different question, not to turn it too much into a fight, is when doing research on what Bridge offers, right, the ability for every issuer essentially to decide, to issue their own stablecoin, right, and decide how reserves are being used, where the yield is coming from and so on, while being atomically enough, right, swappable between one another to unify liquidity. Again, I could be wrong, and this is what I'm trying to set up so you could walk us through properly. How do you ensure that swappability is there and atomicity is there, while the approach of one issuer would be to go more risky versus the other one would be less risky, right? Because at the end of the day, one could decide, okay, there are just reserves in something absolutely low-risk DeFi and something a bit more experimental. Do you just not allow experimental in the first place, or what are the security essentially?
Yeah. Also, just to respond, I was nodding because I was actually chuckling. It's like it's very objective to see the supply, but it's also very subjective to say the best stables in the world. So
Agreed.
I was kind of chuckling.
I was just going with empirical numbers. And
yeah. But with regards to bridge issued a stablecoin, yes, with atomic swap, it does mean 1-to-1. And I think when you ask the question on like the risk, it's probably helpful to like walk through like how exactly does bridge issue the token to ensure this like peg into $1 right? So all bridge issued stables are fully collateralized with either the treasury reserves, or like a mixture of treasury reserves or liquid reserves. So treasuries are like short-term T-bills, and liquid are like basically US dollar you park at a bank. So because it's always 1-to-1 reserved and each of the token is contained in its own, there won't be a situation where it's like under collateralized. And all the reserves are actually OCC and Genius compliant, so it's like very short term. So when you think about it, the duration mismatch kind of risk wouldn't happen like it did with SVB. And then because each of the token is fully collateralized, the choices that each of the stable coin like kind of makes to go, like where it deploys to the DeFi, it's kind of like contained on its own. So compared to other models like Luna, for example, like it just wouldn't happen like that because of how the stable we issue are designed.
Are each one of those managed by the issuer, or is it managed by a centralized entity, so to speak?
Like you mean the reserves?
Yeah.
It's by us. Yeah, so it's like kind of a trade-off there.
Right, so the individual stablecoins building don't necessarily have a choice in what kind of risk it's taking.
Actually they do though. So they can have their, we call it like developer allocation preference. So they can choose the percentage they allocate to each of the, whether it's like liquid versus treasury. And I think we're still making the decision on like, would they be able to choose the counterparty basically? Like, can they choose like a BlackRock or like a Fidelity, whatnot?
Do you guys also allow the ability to back part of the reserves with more volatile assets like gold or Bitcoin, or obviously because
no, it's
makes sense.
Is it just T-bills then?
Yeah, it's just it's 1-to-1, fully backed by all these reserves.
Okay, on the same topic, but more on a primitive level rather than a product, right? Feel what you're working on. If you make that kind of thing as a primitive and you don't have full control over reserves and things like that, right, but you still allow for different assets, different maturity. For instance, okay, let me start it differently. The questions of liquidity versus liquidity available versus maturity started back in the days with STETH, for example, where you know that Lido STETH is properly pegged and everything is fine, but liquidity on chain would be an issue. Then it also got into the topic, okay, what is the oracle then being used for lending? Because so much was looped, you kind of just look at the market price, right, and so on. But instead of going there, let's stop at maturity, right? There are many assets, especially today, that are a bit more tokenized, real-world dependent. There are more maturities and so on. As we get into fixed rates and things like that, it's more so that the assets will have the backend, they will be safe enough, but then there simply won't be liquidity when it's needed at a given time. And that's very important for anything that relates to underwriting it as collateral or credit, right, for any kind of instruments like that. So what's your way of, you're building in that direction. What's your way of ensuring that people can essentially have the liquidity for maturity, but not be the sucker essentially, while buying something that's already like depegged, right? But you're still providing the liquidity. And to add to that, right, there have been some, especially vault protocols, who understand they need it, right? some of them wanted to come up with something like a liquidity layer that would meet the redemption and essentially pre-fund it if a lot of users exit at the same time. But the issue is, again, how do you control for it, right? If you make it permissionless. Anyway, I think the context is set up. You can take off from there.
Yeah, so I mean, if you think about it, in TradFi, there's something called a liquidity premium, which is basically that you're getting paid more for being locked up for a longer period of time. Something that is instantaneous. The reason why treasuries and repos and things like that have the lowest rate is because they're essentially fully liquid and you can trade them and get in and out of them pretty much, anytime. As you move up the scale and you have things that are locked and start having different kinds of risks built into them, you want to get paid more for holding them. And so what we haven't built in DeFi is a way to disambiguate that. And so what you see is lending protocols that charge more for illiquid assets because they have to take on the illiquidity, which means they have to go and find someone who's willing to buy the asset at a discount, and then they're potentially the sucker who's now stuck buying it, especially if an oracle has been misconfigured or hard pegged or something like that. What we're building at Cork is a way for you to actually tokenize both sides of that trade. And so you can take an illiquid asset, say that's my reference asset that I want to be able to trade out of. And I want to be able to, I'm going to pay a little bit of something up front, and I know the exact terms that I'm going to be able to get out of it at. And then you have someone sitting on the other side who says, that's fine. I'm willing to get paid that little bit extra in order to be the facilitator of buying that and be able to basically create that. And they know that they're going to be locked in that trade for X amount of time because they know the redemption capacity, the lockup of the token, as well as the redemption capacity after they get their hands on the token. Is it going to take them 1 day? Is it going to take them 30 days? Is it going to take them 90 days to get out of the token? And so you create a market for that where the market is actually able to price that risk.
Mm-hmm. And in terms of the user base, who do you expect it to be? Because unrelated topic, remember Renzo days when restaking was there, when Eigenlayer, Renzo, and everybody announced their points. The issue was that if you didn't have restaking withdrawals right away, a DPEG happened. And it was a thing that even though, let's say, it was relatively known that everything is fine and restaking didn't even get real restaking in security back then, right? It was all just staked normally. There wasn't like anything like slash.
It was also a huge problem if you wanted to accept the scan token as collateral, because then you have to be able to process liquidations, right?
Exactly.
And
yeah.
if you cannot withdraw, or you can only withdraw up to a certain time, then you have to meet your risk parameters to actually meet that. And that basically stops quite a lot to the growth.
It's an interesting thing for a liquid staking token or a liquid restaking token, which is sometimes there's no risk, right? Being able to get out of the trade, there's a liquid market for it, and there's just the unstaking queue is very short. And then all of a sudden it can become very long and that can turn on a dime. And so right now the way that that's priced is in liquid markets, and that liquid markets provides no guarantee. And so the lending protocols end up having trouble with this because they need to find someone to buy it, but they've set their lending parameters at such a high rate that even if they find someone to buy it at a discount, it's still going to potentially lead to bad debt. And so for something like that, you want to create something that's a guaranteed buyer, where you say, I'm willing to lend against this because I know I have somebody who's going to buy this. They're then going to hold the risk. They were paid for that, and it's now their problem that the staking queue all of a sudden went up. They looked at it and said, for the next 30 days, this is the price that I need to get paid in order to put that trade on. And then the next 30 days, they can reprice it. The 30 days after that, they can reprice it. And it can even get shorter and shorter as time goes on. And you have more automation and more agentic workflows around this, where you can actually start pricing these markets on a daily basis, right? But as a starting point, you probably want something a little bit longer.
So from an architecture perspective, you design it that you have essentially different pools and each one of them is segregated, and there is some abstraction layer on top, or like what's the, I'm just curious, like from the
protocol so from the protocol perspective, the protocol is designed to be an incredibly flexible primitive that you can pretty much do anything you want with, right? Where you can create different markets, and as long as you have a buyer and a seller that's willing to accept a price, that market can get created. What we then will have sitting on top of that is vaults, where you have people who actually know how to underwrite the risk and deploy capital, who are actually saying, here are the pools that I want to actually work on. Where this goes in the future, though, is much more of an agentic system, where you have agentic underwriting. And if you think about just at a very high level how that works, if you go today to take out auto insurance, right, you go to a geico.com or you go to a website, and there's a whole bunch of different sliders. You give them a bunch of information, and then you can choose how big your deductible is, how much coverage you want, do you want an umbrella policy, and a bunch of different things, and then 30 seconds later, you get a price, right? It's not quite an agentic workflow, but it's an algorithm that's doing underwriting on behalf of you. And so you can think about what risk underwriting in DeFi is going to look like in the future to be something very similar, where you come in and say, here's my need, an underwriter is sitting on the other side and says, here's how I'm going to price your need, and then you can meet in the middle.
Cool, thank you. Yeah. Then I'll start with a simple question, and it's a bit of a lazy one, but when it comes to FX, we all heard about FX resurrecting, right, for the past 7 years. It's kind of a thing like we fixed impermanent loss also for the past 7 years. And then you look at it, and it's being solved slowly, but not as much. So what would you say now is the time to do that? At least like in my inexperienced view of like a user in that FX who doesn't build a fixed protocol himself, the issue feels like if I cannot, if let's say I can even trade Forex from one currency to another, if I want to redeem that currency later, I can't do it. So is the reply that when you have it, you don't need to redeem it? You know, like the Bitcoin meme, right? Once it already happens, you will never need to cash out, right, type of stuff. Or did you fix the way that redemptions can happen in different jurisdictions easier enough?
I think for true adoption, you definitely need to integrate the redemptions in as well. I think in order to get like crypto people on board who don't mind just holding stablecoins and like a lot of their net wealth just being in stablecoins and not having that is fine. But like for it to really take off and actually get, you know, the wider world into it, like non-crypto people, where they'll just be doing a trading app on their phone and they don't even know that it's crypto under the hood, I think you need to have the whole pipeline in one go. So you need to have a process where they can onboard, like on-ramp on one end, and then it goes straight into an FX engine, which is running on a blockchain or multiple blockchains, and then get the amount out, and then that could potentially be sent to a different bank account in a different currency, and that all needs to just work in one go. And then I think only then will it be able to completely take on at the world and be the new standard.
What's the fee structure right now for that? Because like Forex around the world, let's say, I think in the US and Europe it functions relatively well. Some parts of Asia it's also pretty good. In many areas, it's just the spread you get is absolutely terrific, right? So when you come to that question in crypto, is the fee structure right now better than in real world? Is it much worse? Is it somewhere in between? Like what are the real world essential institutions asking you for there?
I think, yeah, the biggest hurdle is the spreads for now. Like the spreads in the real world, because it's literally trillions, it's like the biggest market in the world. And then the crypto is like tiny compared to that. And so in terms of like big markets like Euro, USD, there's like literally trillions every single day. And so the spreads are pretty much impossible. I think it's more about the access and also the time it actually takes to make a trade. Like if you were going to go through a bank and get it done as just a normal consumer, to get like the bank rate, it could take you like multiple days. But what if you like needed the result immediately? Then you could get a much worse rate. Whereas ideally, we want to put the whole thing on crypto, where as it scales and gets enough liquidity, you'll be the best of both worlds. Like instant open execution, anyone can just see it, but it also gives you the best rate.
And just quickly +1 on the whole, like the world today, if we want to bring above retail FX on chain, I think the infrastructure is like super immature there. So like there's trillions a day that's being settled in terms of FX, but billion, like 1-point-something billion a day, that's actually moved. That means like more than 95% is just netted. But in order to have this netting, we need a standard and we need credit. And like I think today, I'm not really focused on the FX market. I don't think there exists one today yet. So that's one thing. But also on the flip side of that is like solving for the retail demand, right? Because if we talk about the trillions and the billions, that's more for institution adoption. And for the retail, I do feel like as a ecosystem, we're getting there, because as more stables, different stable that's non-USD get to on-chain, we basically will have the demand to do it, and where there's a demand, there will be a solve.
Yeah.
You also need swaps. Huh? You also need swaps.
Yeah.
Yes.
I think it's happening now though. Like I think the like non-USD stablecoins are like really actually starting to proliferate and grow in volume pretty much like this year and last year. I think like EuroC, which was the biggest one, had a big boost last year due to like various political reasons, basically. But like, I mean, that kind of thing is always what drives FX, as well as like all sorts of geopolitical things. And like when you start seeing that actually happening in crypto as well, then you know that it is going in the right direction.
It's also very complex to solve. It's especially growing non-US dollar denominated stablecoin is one of the hardest things that we have actually seen. We're focusing a lot on a bunch of Tether assets that are not only US dollar denominated. We have CNHT0 live that is currently live on Conflux right now. We have Tether Gold 0, which is not exactly an FX. It's a little bit different, but we kind of use the same mentality. And Tether has been one of the very first to actually go with the old products like EuroT, Mexican Pesos T, and all of them has been growing at a way lower pace than the main US dollar one, because obviously the demand is there. I personally think that on-chain finance and on-chain swaps are one of the best possible way to actually solve this problem. So I'm very eager to see whoever is going to build it this way. And if they can build it against USDT, I'm even happier, I guess.
Watch this space.
Since when did we choose change the phrase from DeFi to on-chain finance? How fast did you sell out? That was quick.
Yeah, since DeFi is no longer decentralized, I guess. That's probably when. I mean, we were talking about it yesterday, right? Like we went into this industry in late 2020, early 2021, and it was a bunch of people thinking that we were revolutionizing the whole money, and that was where the main thing that everybody was focusing on. And then we changed that, and I think it's also part of the natural process of an industry, right? Like you start in a pretty cyberpunk mode, and then you slowly get to something that is a little bit more institutionalized. That's why I like to, when I speak a lot with people that don't like DeFi, as you can imagine, a lot of institutions, a lot of people that have very much been into crypto, but they have no longer been following since, all the meme coins and all the, when we were doing swaps that were called with food name and so on and so forth, that's where they drew the line. So I always try to make the distinction that, yeah, DeFi can be a little bit crazy sometimes, but on-chain finance is the real technology behind it, right? Like I hope that it's going to be decentralized, but if it's not decentralized and it's just on-chain, transparent, and all this kind of stuff, it's something that is good enough for me.
Yeah.
Before we start crying about 2020 again, which I would join you in that,
Yes.
right? Well, but let's speak about today. Are there, because you guys know so much about the issues of redemptions, credit, right, that you don't own your assets and whatnot, not talking about you own your keys, and not like that. We don't go that far right now. Are there stable coins or assets you hold on chain that would be more pure without any kind of like, I don't know, centralized components? Like there have been some experiments, right? Some of them are live, like mentioned in Liquidity, right? There was Reflexer, that I think is a relaunch, and a few others. Do you, of course, there are questions of scale. How can you scale this fast enough and big enough? That is a different topic. And we all know the obstacles with that. But in terms of like you yourself, do you use something like that, or you're like, not anymore?
Not anymore.
Okay.
I used to, but that's it for me.
You trust enough, basically, at this point.
Yeah, I mean,
When you can call the issuer yourself on the phone, this becomes a bit easier, yeah?
Yeah, I agree with you. It's just that, I think there is a demand for that. And I think whoever is going to be able to crack a truly decentralized, permissionless stablecoin that can grow at scale is going to not only make a lot of money, but make something very good for a lot of people. I think sooner or later we will need that. But it will take time. And so far, all of the more exotic iterations of this all ended up very badly, as we know. So yeah, I'm a little bit more conservative lately.
Yeah, the centralized stablecoins are always going to be bigger and always going to have bigger network effects, and so most people are going to end up using them. I think for a decentralized dollar-backed stablecoin to come onto the market and be as prevalent as USDC or USDT, I think that's really hard. What I actually care way more about is decentralized protocols, decentralized base layers, and permissionless protocols. And so you can see things where you can use them and not get censored out of using them, whereas the stablecoins, ultimately, at the end of the day, if you're using a dollar, the dollar is created by the US government, and the US government is going to want to retain control of that. And they're going to do a lot of things to make sure that they do maintain control of that, and it's going to be really hard for you to not be somehow, if you do something adverse in the system, to be pushed out of that system.
Or you could use Tether Gold, just saying.
Trust Tether.
And then I think it goes back to which use case, right? So we average, build, compliant, stablecoin. So the whole point, it's a feature, not a bug, that it's centralized.
A quick exercise, I don't know if you can do it quick enough, but which of one part of your product or protocol that you think can't really be open source or on-chain, whatever you do, versus the other part of the protocol that you think you want to put on chain and open source that you can do, but maybe you haven't gotten to yet. Like, there is always this, like with governance, for example, building fully on chain or not, there is always this one thing that you're like, could be, but like, let's do it tomorrow. So if you could tell about like self-criticism essentially, right? Which one of these two that you can't and that you can?
I think it's not really a self-criticism because we are already thinking a lot about it. And I guess, like personally, I got into the space a while ago because of the open nature of the space. So for me, like open sourcing and like building interoperable things is very important. So obviously for bridge issues, stablecoins, right? The reserve part, because the reserves are essentially T-bills, government issued, or the US dollar. So that part has to be kind of like centralized in this case. But there's a lot of other part about stablecoin that's like whether it's like moving the stablecoin on ramping, whether it's just spending the stablecoin utility, like all those things, or swapping in between different like USDC, USDT, the open issuance at bridge, like all those things, I think can totally, one, be open sourced, two, actually people should try to have a standards. I'm always reminded of the comic where you had like already a bunch of standards. You're like, okay, let's have a new standard, and then you have like yet another standard. But it's really important, I think, like coming from a data background, especially when you have different standards of data, it's just such a mess, right? With USDCs, CCTP, and USDTs like layer 0, it really fixed the fragmentation of various bridges. So the same thing on the interoperable between different tokens. I think that part, we at Bridge are like thinking about how do we do that, and we like very much so want to open source that part.
Yeah. On our side, our whole infra is basically on-chain. The supply backing every single USDT0 in the world is fully auditable on Ethereum mainnet. Our smart contract that holds every single USDT backing USDT0 is the third largest holder globally of USDT at like 4.2 billion. Most of our infrastructure is on-chain. The only part, and very easy to audit and transparent. The only part that we do not advertise publicly and that it's our thing and we don't want people to look into it for security implication is the DVN, which is the actual verifier that checks if a transaction lands on chain A and needs to be executed on chain B and things like that, because we have a lot of security measures on top of that. So every single time somebody moves USDT0 around chains, it looks like something very sweet, very, very easy and very efficient, but it's actually, there's a lot of checks behind the scenes to make sure that no nefarious actors can actually do something shady. So that part, we'd love to be able to open source it, but at the same time, there's a security implication. And when we have so much responsibility as we do, we always want to make sure that whatever we do is secure enough and meets the security standards. So the DVN is the only part that we don't have off chain. And only, sorry, our compliance processes, meaning that we freeze, we blacklist, we do everything regarding when a law enforcement agency requests us something, we freeze USDT0, we freeze XAUT0. We're actually pretty fast in doing so because we believe that users should be shielded if something bad happens to them. And that part obviously lives completely off chain until a multi-sig transaction is processed. And sometimes hackers look at our multi-sigs and try to swap out of USDT0 as soon as we post them. So it's not fun.
Let me try to quickly intervene there. What's the difference between quickly helping users and doing the same thing that happened with USDC this week? You saw that,
competence.
Right?
You need to have a very good compliance team, or you have to be able to outsource your compliance department from someone that has a very good compliance team that can identify situations like that and make sure that that doesn't happen. I think Zach was really spot on when he called out what happened last week. And I'm very happy to see that, at least on our side, on the USDT0 side, nothing like that has happened so far, knock on wood. And to my knowledge, nothing like that happened on the USDT side of the thing either. So it's very, very good to see that the compliance people know what they're doing.
Yeah, I would say on our side, it's very similar to yours, where like all of the protocol is on chain. Like the whole market's on chain, all of the communications even are on chain, but it's very similar in that we're building on top of like interoperability infrastructure like layer 0, and we are doing off-chain stuff to make that as fast and just efficient as possible. So you said you're running your own DVM, we're running our own layer 0 like executor to relay the transactions between chains. Just to get it to be as fast and like efficient as possible. But the point is that's completely permissionless. Like actually anyone can call that function. We just want to do it ourselves because it's faster than the official layer 0 one, so we can get the fastest interop. But yeah, all the business logic, all the market, all the liquidity, everything completely on chain, open for people to see.
So our protocol also is completely on-chain and visible. I think one thing that's not is the underwriting process. And it would be actually very cool to one day have an underwriting process that was on-chain, where you actually could know sort of what the parameters were that someone was willing to think against, so that you don't have to actually go back and forth and sort of try and guess. You actually say, hey, here is actually your underwriting criteria.
Cool. Do we have one more minute? As a research exercise, name, on top of your head, 3, not most, but like, the ones you remember, most competent teams that are a bit more of your competitors rather than friends in the field that you're working on. Let's say whose practices, products, thinking, vision, whatever you respect, and you would say, okay, these are also cool. Just so, because we spoke about our own book, right, for like an hour, so just to get the karma points back. Whoever wants to start here.
Cap, Morpho, and Steakhouse.
Competitors?
Cap Money.
Yeah, but competitors, are they more friends?
So Cap is doing something that's similar inside of a very specific market. They're doing, credit, basically something that looks like a credit default swap for private credit on top of their platform. And so the fact that they've been able to do that and scale that is, somewhat competitive in terms of, we could have been the underlying infrastructure that did that, but it's also really nice to see someone doing that and it being successful inside of a limited scope, and hopefully that means that the broader scope is there. Morpho is just doing things that are permissionless. We're very envious of their vault structures and how that's sort of, we look to that as sort of an example for how to build things, and then Steakhouse on the underwriting side.
Cool, thank you.
Yeah, I would say like just the teams I appreciate most for sure are Layer 0, Chainlink, and Circle. Basically all for their interoperability protocols. And this is because we're building on top of all of those, and in order to do this kind of thing that we want to do, it literally would have been completely impossible a few years ago until they all built these kind of similar interop standards. And then also they're just awesome. They always reply on like a Sunday, so can't really complain.
Ben stole my answer. I'm gonna sue him. Layer 0, CCTP, which has been definitely good. I guess definitely not a competitor, but a team that we very much respect is the whole Aave ecosystem. We think they are pushing the industry forward in a very profound manner.
I will clip you saying CCTP and send it to Paolo. That's going to be funny.
I know. You got to give dues when dues are done. I have to say that we moved 6 times what we in our first year than CCTP moved in their first year. So I will say that, clip that also. But
The disadvantage of going last, I was going to say CCTV and Layer 0 as well. It's just the simplicity, right? Like the elegance, where you have a very clean, like with CCTV, you have a clean burn emit, and that's it. And it's very easy for everybody to understand. Also, I personally admire the Athena go-to-market strategy. I think today, there's other panels who had negative to say about them, but really, like, I think Athena for me is just like a great example how they thought first about demand first, and all these like campaigns they launched, and ultimately it has sustained them usage and utility and users, and they just did it in a very creative way. So
cool. Thank you for being honest. Sounds good. I think that's it.